Last year, when most investors were watching their stocks plummet, one Wall Street legend had an unfair advantage that was identifying winning stocks with massive upside. Like Riot Blockchain before it shot up 10,090%, Digital Turbine before it shot up 789%, Overstock.com before it shot up 1,050%. This power gauge comes from the legendary Mark Papic. Right now, you can get a free in-depth look at how his power gauge system works. A way to type in any of 4,000 different tickers and see exactly where the stock is most likely to go next and in any type of market. Simply go to powergaugepreview.com for a free look. Again, that's powergaugepreview.com. Welcome to Making Money. This is Matt McCall. Thanks for joining me. It is January 12th, 2023. It's a Thursday. We've got a special guest coming on. One of my favorite researchers out there, Marko Papic. The guy is a legend, a young guy to be a legend, but we dive into a lot of things. We dive into areas of the world that he thinks are going to outperform in 2023. We take a look back at 2022 and what went wrong, and Marko believes that we're righting a lot of that. And then we dive into specific sectors. We talk about gold, we talk about metals, and we get his island pick. You're gonna be very surprised on the investment that he's taken to his island for the next 10 years. All that and more coming up right now on Making Money. Without further ado, here he is, the man, the myth, Marko Papic. Thank you so much for joining the show, coming on for the first time. Obviously, I've seen you speak, Marko, at our conferences, and always one of the biggest hits there. People love it. I love it. I read your material constantly. So it's a pleasure having you on the show. Thank you so much for joining us today.
Such a pleasure, Matt. Thank you for having me.
Of course. So let's just jump right into it. I hate to look backwards, Marko, but we had a hell of a year, 2022. You know, I mean, it's tough to kind of ignore. I'm trying to push that behind us, but what are you seeing as far as what happened last year and coming into this year? Are we bringing some of that stuff with us? The inflation, the interest rates, the Fed, et cetera, kind of set us up what we're looking at right now.
So yeah, last year, for those of your listeners who don't know me, I mean, I basically do politics and geopolitics for finance and for investors. And so I don't do it by talking to policymakers or listening to whispers in smoke-filled rooms and corridors. There's plenty of people who do that. I focus on a top-down, framework-driven analysis. And so I think that material constraints force policymakers to do things they don't want to do. And 2022 was a bad year for that framework. I mean, you had Chinese policymakers basically say nah, we can do zero COVID for an extra 6 months. Nobody will mind. You had Vladimir Putin say material constraints to invading a country of 42 million people, largest country, Europe, I got this, hold my beer. And then finally, obviously you had the Fed. At the beginning of the year, very few people, and God bless those who got this right, but very few people thought that they could raise, the Fed's funds rate by 500 basis points, effectively. That was nobody's radar, except people who got it right. And again, that's another example of throwing constraints to the wind. And what I would say to you is I think 2023 will be the year when all those things go backwards, where the material constraints face reality. I mean, we already saw it with China, where they have made dramatic pivots, not just on zero COVID, also in real estate policy, also in foreign policy. They're launching one of their charm offensives, not so much at America, but definitely at the rest of the world. You have the Fed, which is starting to become aware of potential constraints to their hawkishness. And also, obviously, with Russia and Ukraine, I think both sides are starting to face constraints in that it's really difficult to launch an offensive operation, whether you're Ukraine or Russia. So that conflict seems to be entering some form of a stasis. So where I'm getting at is that when you think of all the bugaboos of last year, inflation in particular, Chinese collapse in demand and imports, which is obviously relevant for things like commodities, which did poorly last year. When you think about the Ukraine war, the second derivative of all these things is becoming less pernicious for the markets. And so I'm actually not that pessimistic about 2023. I know that there's a consensus out there of, professional forecasters that we are going to have a recession. Actually, that consensus is the highest ever on record. I think actually a lot of things are moving in the right direction.
All right, so Marco, so correct me if I'm wrong. I don't want to put any words in your mouth, but you kind of seem to be in my camp, and it's a pretty lonely camp right now to think that 2023 could actually be a pretty decent year on a lot of different levels, from geopolitics to the economy and then trickling down to the market.
Yeah, so like if we stick to the economy right now, and you just kind of break up the GDP into its constitutive components, like which part of that GDP equation will be worse than 2022? Let's start with the simplest, fiscal spending. Like 2022 was one of the worst years in terms of fiscal thrust. Why? Because of the derivative from 2020, 2021. So we finally had a year where government was a headwind to growth because of a rate of change. That is going to be much less of an issue this year in 2023. It's going to be flat. So you go somewhere between -3 to -5% headwind to GDP growth. Huge. One of the biggest fiscal cliffs in US history, to flat. That's huge. Second, consumption. This is a tricky one. Maybe my view is controversial, but I think consumption is not going to get dented. Real wages are going to be positive this year. Think about that for a second. CPI declining, which everybody agrees with, by the way, whether you're in the recession camp or not, consensus is we're going to settle somewhere 3 to 5%. Well, nominal wage growth in the US, if you look at the Atlanta Fed wage tracker, is at 6. So when CPI goes from 10 to 3, OMG, you're talking 3% positive real wage growth. That's going to boost consumer confidence. On top of that, consumers in the US survived 2022 despite negative real wages for 4 quarters in a row. Why? Because access to credit has been plentiful. Like banks are lending for whatever reason with Fed funds rate at 500 basis points. I don't know, but they are. You have massive savings. Yeah, but Marco, consumers are drawing down on savings. Yeah, but they still have plenty of savings left, unless you're in the bottom 20%, which obviously is important. But the other 80% in the US have ample savings. And if you look at the gap between home equity and home debt, it's enormous. It's never been as wide as it is. Real estate prices are coming off, doesn't matter. The home equity built up over the last 3 years in home prices is gargantuan. So I think consumption is going to hold up and actually drive the economy, which obviously matters. Then you get to investment. I think that's the one where you could have a hiccup in the US. Obviously, 500 basis points Fed funds rate could start impacting capex, but it hasn't yet. Despite the lowest CEO confidence, the lowest CEO confidence over this century, 9/11, 2008, COVID, it's worse. CEOs are more depressed than ever, and yet they continue to do capex. That might change. There could be a drag from investment, but I just don't think so. Not in a world where we're trying to replace China through onshoring, friendshoring, whatever shoring. Not in a world where you have green tech revolution, which is going to take a lot of money of investment, and not in a world where we haven't done any capex outside of tech in 20 years. So when you put all of this together, then there's net exports. Dollar has peaked in my view. I think US exports will do fine. China stimulating. I struggle to find which part of the GDP equation is going to be a problem. And, I hear people say, but Marco, if real wages go up, earnings are going to go down. No. That's why CPI coming down is magic. It's truly magic. It's like it proves magic exists. Why? CEOs are depressed. They're not going to give you a wage increase. Nominal wages are going to be flat, if not go down, but people will have more money. That's what happens when CPI goes from 10 to 3%, people. And that's why I think we literally are going to get manna from heaven as CPI comes down. The one way I can be wrong, of course, is the Fed says, look, 3 to 5% CPI is not what we're in here for. We want 2. Mm-hmm. Then I'll be wrong and we'll have a calamitous recession.
Yeah, I mean, I'm so happy you brought up real wage growth, because it's a topic I talk about a lot, and I feel like the mass media ignores it because, as you mentioned, I mean, there's nobody out there that believes that inflation is going to go higher from here, that it hasn't peaked already. I mean, and if they do, I don't know what the hell they're looking at. So as it comes down, like you said, suddenly you're like, your employer's not going to be like, all of a sudden, hey, inflation came down, I'm going to take back some of that raise I gave you. It's just not how it's going to work. And there's still demand for jobs. So, it's tough to get behind the consumer, especially for me as a stock market guy, to invest in retail stocks. But some of them are actually looking for something pretty damn good. Like the consumer remains strong. I'm like you. You probably travel a ton. I traveled so much in the last 2 months, internationally. Every airplane's full. Every airport's
Every
full. Every bar stool's full. I mean, that's not the sign of a deep recession coming. I don't care. That's the eye test, in my opinion.
Yeah, so if you look at the global credit impulse, which is basically credit creation, whether total social financing in China, bank lending in Europe, bank lending in the US, it's strongly positive. It's turned, and it's turned like 6 months ago. So there's ample credit. M2, global M2 is also picking up, even though it's coming down in the US, but from in kind of like absolute terms, M2 is at the highest level ever. So when I look at all that stuff, I think it's tough. It's tough to see how we have a very deep recession, if any recession is either. And yes, I last 3 weeks, 4 weeks, I was in like Singapore, Tokyo, Seoul, Kuala Lumpur, Abu Dhabi, Dubai, Istanbul. Like a lot of travel. And you're absolutely right. Even in a place like Turkey, everything is booming.
Yeah. Speaking of that, not to make a major shift, but you just mentioned a lot of emerging markets. I know you're a fan of the emerging markets right now as an investment opportunity, and I can't agree with you more. They've been overlooked, and I agree. Dollar obviously has something to do with that. I think the dollar has peaked, and I think that's going to roll over, especially some of the commodity-producing emerging market countries that are out there. Why don't you give us your view on how you're looking at the emerging markets right now, the opportunities abound?
So I think that emerging markets have been unloved for a very long time. And that's because, a lot of institutional money, institutional investors feel wronged, feel spurned. I remember a lot of them pounding the table in 2011, 2012, like, no, we're going to stick with emerging markets. The BRIC story, the Jim O'Neill famous BRIC story from 2001 is still here. And it wasn't. It was a really bad decade for emerging markets. You should have just basically bought NASDAQ in 2011 and gone to sleep. Gone on a 10-year vacation, you would have done amazing. And so it's very difficult when you talk to professional sort of allocators, institutional investors. I mean, the reason they have jobs, Matt, in 2023 is because they were the ones that survived the emerging market calamity. Their colleagues that stayed in emerging markets, in terms of global asset allocation, don't have a job anymore. So the survivors in the institutional investment space, I feel, have a bias towards privates and tech, not towards emerging markets. But the truth is, emerging markets are going to benefit if this truly is a capex-driven cycle. If this truly is a cycle that looks like 2001 to 2011, if this is a cycle of building factories, building new fabs, trying to not completely take China out of the global supply chain, by diversify from China, create redundancy, create a little more inefficiency in the sake of national security issues. When you start putting all of that together, you see a world that's driven by commodities where emerging markets are going to do well. The other thing that I would say is that unlike the West, in particular the United States, which is basically like, YOLO, let's print, it's all good. Like everyone's like, oh, Jay Powell is fighting inflation. What was he doing in 2021? Well, what were emerging markets doing in 2021? They were raising interest rates. They took the lessons of the Washington Consensus, of the Ronald Reagan and Margaret Thatcher Revolution. They took their lessons of being profligate and populist-driven. And for the most part, other than a few holdouts like the Argentinas and Turkeys, most emerging markets did the painful monetary policy adjustment in 2021. They got, and their balance sheets are much better looking. So I think there's some real gems in emerging markets. The countries I like the most in a structural are Latin American economies. Indonesia is probably my number one pick. Also temporarily, like over the next 6 to 12 months, countries like Thailand should do really well because there's about to be like tens of millions of Chinese tourists just like begging to go somewhere, right? If we hold up in China for 3 years, like they're going to go. So you're going to have a little bit of idiosyncrasy like that too. But I think commodity-producing emerging markets should do really well.
Well, I want to talk about energy and gold, but before that, just one other country that I've been reading about in your work, Marko, is Japan, and a lot of other people are starting to turn a little bullish on Japan, myself included. What do you see for Japan going forward?
So I call it a coiled spring. JPY obviously had a terrible year last year. And normally that should be reflected in the Nikkei in terms of performance, given the exports heavy kind of Nikkei industries. That didn't happen. And so it's kind of a puzzle, like why didn't it happen? Well, actually, because a better predictor of equity performance in Japan than currency is Chinese imports. And Chinese imports fell off a cliff for all the reasons that we already know in 2022. So given the really aggressive policy shift in China towards emphasizing domestic growth over everything, the geopolitical confrontation with the US, put it on the back burner. Like, we've got decades to deal with that. No, it's all about growth. It's all about growth. COVID's nothing, like it's all good.
Yep.
So I think that should really spur Japanese equities this year. And now there's some like risk out there that BOJ becomes hawkish like other central banks. I think the median investors overstating their hawkishness. I don't think they were becoming hawkish by adjusting their yield curve control. I mean, for God's sakes, they still have yield curve control, right? I think what they were doing is just dealing with liquidity issues in the bond market. And so, my team and we remain very bullish on Japanese equities.
Okay, good. I'd like to hear that. And then they're obviously building up their military for the first time in decades, so it'd be a lot of money going into that. So I think that's going to be interesting.
Also, just like if you agree with my thesis that tech is not going to do well for the rest of this decade because this is a capex-driven cycle where like industrials, materials, and energy do well, well then you can just, don't be too fancy. Just choose equity markets where the tech part of the equity index is low. And Japan is one of those. Japan kind of missed the digitization decade, but they are really good at materials, industrials, and even some energy. And so I think that they're going to outperform tech-heavy markets.
So when you say tech, basically for the next decade, I know you believe in innovation. Obviously there'll be more, let's say, electric vehicles on the road. There's going to be greater artificial intelligence. That thing that Microsoft might buy into, the smart kind of search engine thing. So do you still believe in that, or do you think innovation itself will slow down as well?
Well, I'm going to disagree with everything you said.
Okay.
I don't believe that we had innovation over the last 20 years.
Okay.
I'm a Luddite,
Yep.
And let me explain why. I believe in Bob Gordon's thesis that all this tech mumbo jumbo is not reflected in productivity growth because it hasn't given us any. So let me back up here.
Well, real quick. So you're saying 20 years. So 20 years ago, we didn't have my iPhone, right? So my productivity has gone up through the roof.
Has it though?
Because I travel the world. I'm going to Hawaii in a day. I just booked a ticket this morning. Like I can do whatever I want. I'm productive instead of being locked in this room.
I don't know, because you might, Matt, you might be special, but a lot of us use these. We use these smartphones for like idiotic things. Let me back up and get philosophical.
Sure.
If we got a little bit of time,
yeah,
I want to talk slowly, and philosophically. Okay,
please.
Francis Fukuyama wrote the famous essay that became the book, "The End of History and the Last Man." Right. This is a famous, 1994 book. I think 1992 essay. And basically what he argued is that with the Cold War over, with Western democracy and laissez-faire capitalism ascendant, we ended history. And what was interesting, everybody remembers that part of his argument, but they don't remember the last man part of it. The last man is this Kantian-like concept of a person filled with ennui, boredom, and lack of direction. And what that meant is that all the technological innovation since Francis Fukuyama wrote this piece, because I agree with him, there was this moment of ascendancy. There were no worries. There was no threats. We focused our technological innovation on satisfying the needs of that last man. And the needs of the last man are really mundane, simple, and not really productivity enhancing. They don't solve problems that are like profound. Effectively what the last man wants is to use technology to have more dating choices and then eat a cheeseburger at 3 a.m. Now, I'm being obviously hyperbolic and facetious, but if you look at it, a lot of the innovation that happened, great businesses, great return on investment, SaaS businesses have high profit margins. We all understand that. Awesome. But fundamentally, the reason I disagree with you that this really changed anything is that in 1994, we got Microsoft Excel. In 1995, we got the World Wide Web. Period. End of sentence. Everything since then is a variation on those two themes. Like, is Google better than 1990s Yahoo? Obviously, we know who won. Mm-hmm. But is it that better? You know, like you're saying, like, hey man, I can buy a ticket on this thing. Like, yeah, but you could have done it on like the computer, look at the desktop. It's not that. It's marginally better, but like the real utility. And by the way, this is what the data shows. The data proves me right. Total factor productivity in the United States of America basically flatlined for the last 20 years. And I don't believe this bunk that it's unmeasurable, please. When we invented penicillin, it was difficult to measure its impact on productivity. Eventually, it showed up in productivity data. This stuff has not for 20 years. So where am I going with this? I disagree with you that the last 20 years we've had impactful technological innovation. But unlike Bob Gordon, who's a pessimist in his epic book where he explains this technological disappointment, I actually think we're at the cusp of the best 20 years in human history since 1870 to 1920, which is when most of the really, really big technological innovations happened. Why do I think that? I think that because we're in a world where the state is back. It's not up to the last man and his tech bro buddies in Silicon Valley to decide where trillions of dollars of investment is going to go. So it's not going to go into delivering cheeseburgers at 3 a.m. or getting you home after you're at a bar, What it's going to happen now is with the state coming back, there's competition between states. The last man's not going to get a choice anymore. It's going to be the state that says, hey, listen, hold up. We need independence from foreign energy. We need to get this fusion thing right. Let's put money into that. We need to beat China in semiconductors. Let's put money into that. Now, I don't want to sound like I'm like some statist, like communist, like I know everyone listening to this who like believes in the Chicago school or laissez-faire is lighting themselves on fire. No, hold on. All I'm saying, the state is going to create like goals that are going to be profound. The private sector is going to still be the one innovative. But capital is going to be allocated to profound things because countries are now in a profound conflict with one another. And I think that's actually really positive. And that's why that 1870 to 1914 period, and I use that specifically, was so important because that was the last time we as humans experienced geopolitical multipolarity, global context in which states are at each other's throats. It's every country for itself. And I think that's going to spur incredible innovation, but it's not going to be in software. It's not going to be in computational things. It's going to be in kinetic things. And that's why I think this is going to be a decade of industrials, materials, and energy.
So if I'm going to agree with your argument, for just argument's sake, I'm going to agree with you, then that leads me to believe, if you are correct, Marko, that China should be a great investment, because if you're looking at the state, say what you will about their government, but they have had a hell of a plan the last couple of decades, playing a slow game, basically coming up to the second largest economy in the world. And they're pushing what I call innovation, but, might look different to you than me. But how do you ignore China then?
Well, a couple of ways I would ignore China. Or not ignore China, but here's a counter to that. First of all, they are like the US in that their equity index is laden with last decade's winners. Mm-hmm. So just keep that in mind. Now, that doesn't mean that like they're not going to innovate in hard tech, but they are laden with just software and kind of TMT sector. The second thing is that you don't need the government to actually be in the business of innovating. What you need the government to be in the business of setting goals. And then you need a private sector that can execute on those goals. And this is something that Professor Mariana Mazzucato, I don't know if you've ever had her on the podcast, but she talks about a mission-driven economy. This is really what it's about. It's not like having a statist innovation board. No. It's about just setting goals. And those goals then create ancillary technological innovation that oftentimes is driven by the private sector. I think the jury's out if China can do that well, but I don't disagree with you that at least they have preempted the shift away from software. What do I mean by that? For whatever reason, they figured out that this was going to happen, and in 2021, they took a revolver, filled it with bullets, and shot their own TMT sector, right? That was the big regulatory push against the kind of platform economies, as they call it. And they they have surged now. They are emphasizing hard tech innovation, EVs, semiconductors, green technology. In the case of the US and the Western world, like our own market did that on January 4th, 2022. We all came back from New Year's revelry, realized Omicron is a joke, and the 10-year just skyrocketed. Since then, tech has been killed. The Chinese kind of got themselves a 6-month head start on that. The rest of the world is now moving in the same direction. And if you actually look at the performance of different equity sectors, tech now lags. It doesn't lead anymore. When you get like any rally, tech is actually IT, communication sector is actually dragging behind. And I think that's going to continue. So yeah, yes, China I think will do well, but I think you'll be surprised by the winners. I think South Korea's, the Japans, the Europes, those are really the places where we innovate on industrial materials and energy. I think the US should do well as well. It's just that there will be some rebalancing of the US equity sector, which obviously, like tech is still like 27%. So.
Yeah, so if you're looking at just the general indices, I understand that. It's way too heavily weighted in tech and in several large names. So you're basic. You're not diversified like you used to be. So I agree with that. And I'm an innovation investor. That being said, Marco, if you looked at my portfolio, a bunch of rare earth minerals, all kinds of stuff. It's not just tech. A lot of times people think innovation, they think tech. That's the same thing. I don't view it the same thing. I think there's going to be innovation in medicine. I think medicine's going to, in the next 10 years, is going to blow our mind what's going to happen.
Oh, absolutely. And by the way, COVID-19 is a great example of what I'm talking about. We didn't solve COVID-19 because there's like the United States vaccine company owned by the government. No. What happened was the Trump administration showed up, Operation Warp Speed, baby. Whatever money you want, we got you. And private sector competed, and you got 2 vaccines. But that's a mission-driven. That's a great example of a mission-driven innovation. And it happens so fast, man. Yeah. Watch Europe for the next couple of years. I think the technological innovation that's going to come out of Europe on the energy front, due to the necessity created by the Ukraine war, is going to blow everyone's mind. So everyone right now is like short Europe, they're deindustrializing. Nah, that's the exact opposite of what you should be doing. That crisis there in Europe is going to spur innovation in industrial and energy sector. You want to own European energy, you want to own European utilities, and you want to own European industrials going forward because of the crisis.
I love that. I did a big webinar a couple years ago, and it was called Crisis and Opportunity. Within crisis comes opportunity many times, and you laid it out perfectly for me. I agree with that thesis 100%. Before I let you go, Marco, I ask every guest, and you don't have to answer, but ask every guest the island question. So if I sent you, your family, friends, whoever you want to take with you to an island for the next 10 years, can't take your phone, no innovation with you, can't take it with you. And what's the one investment? It could be an asset class, it could be a stock, it could be anything. What's the one investment that you feel safe taking?
So how long do I have?
10 years.
10 years. That's a great question. I don't want to say something like a sector. I want to make it sexier than that. Look, I think nuclear technology has to be part of the mix.
God bless you. I love that.
I don't know how to express it.
Yeah.
I don't know if it's uranium. I don't know if you want to pick a single stock. I don't want to name any individual equities. I don't think I'm allowed to, whatever. But I think European nuclear actual innovation and technology companies, that's what I would get. I would get a basket of those because, Germany basically banned nuclear power, and that's not going to come back. They might prolong a few more reactors or whatever, but it doesn't matter. Right, guys, stop caring about this. Germany is Illinois. It would be like saying like, oh, Illinois banned nuclear. Who cares? Ohio did. You know what I mean? Like, France does not care. They're gonna LFG on nuclear power, and they're going to service the other countries in Europe. And I just think it's a clear mix for Europe. And then of course you have, what you already know, China build out other countries. I just think it's a clear. Now the big risk to this is fusion. To this thesis, but hopefully I'll get picked up off your deserted island in 10 years before fusion shows up.
Exactly. Yeah, we'll come get you. Oh, awesome. Marco, thank you so much. I could talk to you all day. Again, I mean,
Same
you
here,
have
Matt. Thank you.
great admiration for you. I think what you do is amazing. So please keep up the good work, and hopefully we'll get you back on here soon. But again, thanks for making time and coming on the podcast.
Awesome, man. I'm humbled by that, Matt. I make a lot of mistakes too, so we can come back in 12 months and see what was right or
That
earlier.
sounds good. Sounds good. All right, thanks, Marco.
Thank you, Matt.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.